Welcome to the Nick Hilera Show. This is the place where we explore big ideas with people having a big impact on our world. I'm your host, Nick Hilera, serial entrepreneur, author, early morning riser, and seeker of truth and wisdom. Join me as we explore the journeys and discoveries of fascinating people who are literally unlocking the secrets to creating a life of both success and fulfillment. Each episode will arm you with insights, ideas, and practical perspectives on what it takes not only to be financially and personally successful, but also how to start having authentic impact on the world around you. Hey everybody, thanks for tuning in. What you're about to hear is my conversation with Jack Farley. Jack is the host of Forward Guidance, which is one of the most popular finance shows in the world today. I wanted to interview Jack because he sits in such an interesting position. It's his job to literally sit down and talk with the smartest minds in finance around the world. I just knew he would have some interesting things to share. What Jack's doing in my mind is a great public service by shining a light on key issues and demystifying complex matters of finance and economics. Jack is helping people get a better understanding of our world. What follows is an incredibly wide-ranging conversation where we get an in-depth view for how Jack thinks about the art of investing and just what's going on in our crazy world today. Hope you enjoy. Welcome, everybody, back to the Nick Hilera Show. Today, we are welcoming a very special guest, a person who really needs no introduction, at least in finance circles. It's Jack Farley, who is the host of the ever more popular show, Forward Guidance. Jack, welcome to the show.
Pleasure to be here, Nick. Thank you.
Yeah, I'm super excited to have you here because there's just like a million questions that I have to ask for you. And normally you're the person asking the questions. So this is like an opportunity to kind of flip the tables a little bit and put you in the hot seat. And so if you don't mind, I kind of want to just get right into it.
Yeah, sure. Do it.
All right, cool. So one of the things that I've been curious about, and I'm guessing that maybe your audience at Forward Guidance is as well, is just how you think about investing. Like, what's your style when you manage your own portfolios? How are you doing it? Are you, a value person? Are you a trader? I don't think I've ever heard you, speak about that publicly. So I'm super curious to just get your take on that.
Yeah, that's a great question. And I intentionally don't talk about it. Especially I feel like if I'm involved in a stock that's, a small market cap, like, less than $1 billion, it's on the one hand is like, I really don't think I have an influence. Like, it would be arrogance of me, like I can move the market, but like, I don't even want to risk that. And even if it's not true, which I don't think it is, people might think that is true. And I don't want that for my reputation. But yeah, I am a pretty active, investor and trader. And I feel like that's a mistake that's common. And then I make that as well, of like a trade becomes an investment becomes a trade. But yeah, I'm pretty active in like single name stocks where I do a lot of individual research. And actually, like, I'd say, a big hero of mine, like this, I am of the school of Warren Buffett in terms of like, you should do research on an individual company. And do you think that company is going to make money? How are you going to value those future cash flows? And yeah, and then overlay the macro on top. It's just like, you're a real estate investor. You're not going to be like, oh, because the Fed is doing XYZ or because inflation is ABC, I'm going to buy a building. It's like, do research on the building. Like, what are the bricks made of? Is the building about to fall over? And that's one thing. I am kind of astute. Like, I feel like as an investor, the way to make money is to be long and to focus on companies that have a lot of prospects. But I feel like I kind of have like the short seller like devil in me, in terms of like, I do like to explore businesses that are bad businesses, and I like to learn from failure, and so I'm not like a super active short seller, but yes, sometimes I do. And I like I was pretty active in the de-SPAC market. Like, what people call SPACs are actually kind of like bonds, because you can redeem them at $10, but once they change their ticker, that's a de-SPAC. That's kind of like a nerd formality thing, but and yeah, so like I'm no stranger to like shorting stocks that have a hard to borrow fee of like 400%, which is not like, I say that like it's a brag. It's like it's like, oh, I'm so complex financially, but it's like it's not a smart thing to do financially. But it's like, yeah, I would say so. To sum it up, Nick, I would say I walk the walk.
All right. I love that. So it sounded too from the very beginning of your answer that though you are sort of intellectually disposed or inclined to be like a Warren Buffett type investor, meaning like let's pick good companies and do bottoms up research, you do dabble in the trading and some there are some short term things that you're doing as well as part of your process.
Yes, that would be fair to say. Yes.
Hey guys, this is Nick. I wanted to take a quick break from the episode to share some exciting news. In addition to the podcast, I want to make you aware of some additional content we're putting out. And best of all, it's 100% free. Our Profit Plus newsletter consists of weekly insights about what it takes to find meaning in the pursuit of modern success. This is the place where we explore big ideas at the intersection of markets, business, politics, and life as we seek to empower our readers to have an authentic impact on the world. If you're serious about finding fulfillment amid success, then definitely check out these additional insights. Just go to subscribe.nickhilaris.com. Again, that's subscribe.nickhilaris.com. Now let's get back to the episode. And how are you always short something, or is that just like only if you see something crazy like the SPACs?
So I'd say sometimes I have like short positions in a few things, but I'm not always short new things. Like sometimes, I'm not like shorting a new stock every day, but sometimes, I have a core position. I have just sort of a basket of names that I won't discuss, but that I think are like a good hedge. And this is something else that the word hedge is kind of the word that is driving me like up the wall, because I kind of thinking like the whole thought about like, oh, I'm going to be long this SaaS, like software as a service company. And I know it's good because I'm so smart, but as a hedge, I'm going to short this stock that the herd, the fools in the market that, they don't know that it's a bad stock, and I'm going to profit from that spread. It's like, you don't know. Nick, have you seen the movie Moneyball?
Yes, but it's been a while since I saw it.
It's been a while. Okay, so Brad Pitt
Yes.
is like the coach who's implementing this data thing, and he's talking to this scout. The scout is like the guy who picks like, oh, he's got a good swing, like he's strong, and scout is very shallow, and he makes all these things like, oh, Nick, like but by the way you look, by the way your confidence, like I can tell you're a good player, like. And Brad Pitt said to the scout, he said like, I've been in those rooms and I've heard the scouts say like, when I know. And he's like, here's the thing though, you don't know. And that's what I feel like is true about most investors, and certainly true about myself. It's like, you don't know, and you're short, and I'm just picking these names, like you're short Twilio and you're long DocuSign because you did all this research. It's like someone who did more research than you has the exact opposite position. And you may be right, but prepare to be crushed.
Yeah, I think it's smart to. I'm not surprised to hear that you've approached this art with some like humility, because just knowing you as I do. But I think it's really an important aspect of the psychology of investing is sort of walking this fine line between you want to be self-confident and you want self-confident and you want to express your self-confidence in the decisions that you make, but you have to bring to the table this humility, or the market will serve you up some losses.
Yeah.
Sort of the more confident you are, the less humble you are, like the more likely you're going to get hurt in some trade or investment decision that you're making.
Yes. And I also think that having a full-time job that's not trading is a huge disadvantage that almost guarantees that even smart people who are doing research and who are familiar with and doing their own research, it's just really tough if you're competing against someone who's like working 90 hours a week to make money in the market. If you're like an engineer or a nurse or a truck driver, like, and you have a real job, like you know what I mean? It's just like people who play soccer on the weekends, like they don't expect to beat David Beckham, but it's kind of, and like, again, and so that's why it would, the way, Nick, you talk about real estate, you're like, yes, like, look, I've had my success, but like, it's very difficult. I got lucky and I learned a lot and it's my full-time job. You're not like the Nick Hilaris school of real estate investing. Like, it's easy. In real estate, it's so much, I mean, I don't, real estate's not really my world, but like, it's even more so than in stock trading. Like, there's so many people, I won't name names, people who are like, real estate investing is easy. Like, all you have to do is borrow as much money as possible. Like, we're taking the biggest loan possible. Like, no, No,
Yep.
fuck that.
Yeah, house prices always go up, yeah, actually when I first started doing this kind of creative work that you do for a living, one of the pieces of feedback that I got, which was positive, was like, hey, Nick, you're the only guy in real estate out who's not trying to scam people. And I think it's a compliment. It was a nice compliment, but I do think it's true. Like if depending on if the algorithm figures out on social media that you're interested in real estate, you will get served up like a bunch of more or less, they're not necessarily like frauds, outright frauds, but it doesn't appear that the people who are putting together these education programs or whatever they are have their customers' best interests in their hearts. That's the feeling you get when you engage with this stuff.
Yes, and also it's just a fact that like the easiest way to make $1 million is to start with $970,000, and put it in a treasury bill that pays you 3%. Like it's to turn $1,000 into $1 million. Like no one does that in a year. You know what I mean? Like literally no one. Like it's just like I think the pursuit of like fast money and quick riches is it's a really bad thing, and it can be quite toxic, and like it's an inherent appeal for everyone, for me as well. But I think it's important to realize that like there's no such thing as a free lunch.
Yeah. I agree. And it leads me actually to a question. I'd planned to ask you this later, but I think now, just based on the answer that you gave, that this is a perfect time to ask it, because it's something I've been thinking about for quite some time. And I know, Forward Guidance is part of Blockworks, which is an amazing company covering, in large sense, the crypto. They cover more than crypto and the technology around crypto, but like your show, but they are focused on that. And, the question is like, do you think what we saw in 2022, let's say, or 2021, was just like that speculative, like, let me try to get rich as quick as possible, just on steroids and like a bubble? Or was something else going on during that time period? What does Blockworks think about that? Or what do you think about that?
Let's take a quick break to hear from our sponsor. This episode of The Nick Halera Show is brought to you by Metros Capital. If you're an investor looking for direct access to real estate investments, then we'd love to talk with you. Investment opportunities at Metros Capital balance financial returns and community impact. To learn more, contact us at metros.nickhaleris.com. Again, that's metros.nickhaleris.com. Now let's get back to the episode.
Well, I think what Blockworks thinks, and what I think would be different. First of all, yeah. So Blockworks, the company that is the parent company of Forward Guidance, pretty much is exclusively focused on digital assets. A handful of exceptions, such as my own show, which is almost exclusively focused on traditional financial assets. And I'll say, yeah, that I'm not like a crypto like a inherent crypto enthusiast. Like I'm not a crypto hater, but I'm approach it with the healthy skepticism that I think I do towards all assets. And Blockworks, to me, like the reason I love Blockworks is not because it's a crypto company, it's because like it's run with character and it has like a really good long-term vision. And I think that's important for people who are in the workforce, is that it's you gotta be working with people and working for people who you have a lot of respect for, and you think who are going to do the right thing. So my being at Blockworks is not like, oh, Jack works at Blockworks, so he like loves crypto. I've learned a lot more about crypto, and I'm really interested in the parallels between traditional finance, TradFi, and crypto. Like, like the crypto people, they're learning about this funding curve thing, whereas like people who work at the big banks, the futures, the forward bias, how interest rates affects like the forward curve, like they know that. Oh, but the crypto people, they're discovering this thing, and people in traditional finance are totally dismissing it, because in crypto there are many speculative bubbles, just like there are in traditional finance. And so it's very easy to dismiss because Charlie Munger said it's Bitcoin's rat poison or whatever. But so that's kind of the core of just that's like a premise. But to your question about what happened in 2021, I think it was a speculative bubble in all asset classes, in bonds, in cash, in crypto and in stocks, and like very high quality companies. I'm just going to say Apple. There are so many others, of course. They were bid up to valuations that seemed extreme, and they were extreme, but relative to cash, which was basically zero because interest rates were at zero, they actually weren't that expensive. And if interest rate is paying you 4 basis points, I just Warren Buffett just did an interview with Becky Quick, who I think is a just phenomenal journalist, and obviously tons of respect for Warren Buffett. And he talked about how he was being paid 4 basis points, Berkshire Hathaway, like a little over a year ago. Like, yeah, Apple at $3 trillion, it makes a lot of sense. And Bitcoin, why not? I feel the way about Bitcoin, the way I feel about gold, which is that it's like a call option on. Okay, first of all, I really am skeptical of people saying like XYZ is a call option on. It's just like if someone tells you that this real estate opportunity is a call option, just run, don't walk, run. But that being said, it's like it's a call option on like fiat money debasement, and as worries about fiat money increase, Bitcoin value goes up, and they're just demand dynamics that can make it attractive, or not even make it attractive, can make it go up. Just like there's only 21 million of them. I'm gonna take a water break.
Yeah.
But I feel like it like gold, it's a call option that will increase in value as worries about fiat currency increase. But it's a call option that really can never be exercised or should never be exercised. Like I think that a system of hard money where you need to mine new metal from the ground in order to create credit, or to mine digital money that of which there's a fixed supply. Like it's like, oh, hey Nick, yeah, sorry, we want to roll your loan on your multi-family apartment building, but like there's the hash rate is too low. Like there's just no more gold in the ground. It's like I think it's a pretty bad idea. And so I think like I'm not a hard money guy. Like there are people like, oh, I'm a hard money person. I'm not a hard money person. And there are people who are on rapid parts of the extreme. I'd say I'm like a someone who recognizes that like a fiat currency has its advantages, and that at least the gold standard like was a kind of disaster. And I think like a Bitcoin standard where it actually is money, that would be like a bad disaster, and I don't think it's ever going to happen. But that's different than people owning it sort of as a reserve asset in the same way that they would own gold. So that's Bitcoin. I feel like my understanding about Bitcoin, like my understanding about crypto, is so low relative to like what's possible. It's increased. It's gone from like 0 to 0.0001. But on Bitcoin, I feel like I can wrap my head around it the most because it's maybe like the most simple and the most available to macro people. Whereas like Ethereum, like, I don't even know what it's called. Like that starts to get like really in the weeds really quick, and I feel like about like there's so many different acronyms that I feel like very confused about in crypto, that probably people who like CMBS, they don't know what CMBS is because they're not in the mortgage business or the real estate business. But like if you're in it, you're just tossed around CMBS, agency, non-agency, blah blah blah. But like I feel like a little bit there's jargon, and there's in finance, like a lot of the jargon I'm familiar with, like within my realm of I'm a like generalist. But yeah, crypto, there's a lot of stuff I still don't understand. So I feel like there's a lot of use cases for crypto that are outside of just like, oh, it has to be the global money system, and there's only 21 million of them, so there's never going to be any money printing. I mean, I remember I asked Lynn Alden, who's just a phenomenal analyst, who she likes Bitcoin a lot. I said, so in a system with a Bitcoin standard, or a system where Bitcoin standard, gold standard, or a hard money standard where there's basically every single bank deposit has the money there. There are no loans. I was like, who prints money? And she said, no one. Like, you need someone to print money. Like that's my own prior beliefs that like I could be wrong, but that's just what I believe. So, what's your response? I know I've been rambling for a while.
No, that's interesting. I mean, I think I agree with you. So on the speculative bubble point, I agree with you for sure. Like, I feel like it was a different bubble than what we've seen in other bubbles, like the residential mortgage bubble that we had, or the tech stocks of early 2000s, where like it didn't exactly feel like that, where there was like clearly out of control, outside of crypto, out of control leverage and easy to get loans, or stuff that you normally see in a speculative mania. But certainly the prices went crazy, and they've come down. And crypto almost certainly was a speculative bubble. Like, when people started coming out of the woodwork who've never been invested and started talking to me about how crypto is going to be their lifeline to solve their life's problems, I was like, okay, this is it. This is the beginning of the end for crypto.
Yes,
for now,
but Nick, you were into Bitcoin back today, right?
Yeah, no, and I still am. I still hold Bitcoin and ETH. Absolutely. Like, I think there was so much there's so much other garbage going on that the true thrust of the movement and the technology got kind of like pushed to the wayside in favor of this, like, in some cases outright fraudulent behavior, and in other cases just like, how do we make money speculating on other cryptos? Like, all this sort of DeFi stuff was all just gambling.
Yeah, Nick, there's no doubt about that. And I think, many crypto bulls and true believers like would acknowledge that. I mean, like, look, there were, how do you say it? Like, adult film actors. There were adult filmed actors and actresses who were paid money to like promote coins. Like, I mean, when you ask me if it's a speculative bubble, what do you expect me to say? But here's the thing where I actually do disagree with you is you said, okay, residential real estate, it didn't feel like 2000s technology bubble, didn't feel like the residential bubble 2005, 6, 7. I think that in the stock market, there was a lot of speculative bubble that people gloss over, particularly like speculative technology companies. Like, and I'm not just talking about like Kathy Wood, where it's those stocks where it's like the company, I'm talking like the legitimate fraud where like, I'm not going to name the name. I mean, whatever, but it's a electric vehicle company where the founder is, he was born and raised in China, and like everyone in China, particularly in the investment world, knows of him as a financial criminal, and he's like not allowed back in China. Like, he's not allowed to do deals with Chinese banks and stuff like that. And China is kind of the wild west in some ways in that regard. He had a SPAC. He had an electric vehicle company that had a SPAC, and it de-SPACed, and it's now trading at like 50 cents. And that's one thing when people get on their high horse about like the Chinese regulators are blah 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 blah, and they're right, of course, that there's a lot of fraud in China and not as many investor protections. But it's like the guy's not allowed in China, and he has a SPAC in the U.S. So there's so many companies that like they're not like Nikola, the company that's it's a hydrogen fuel pack electric vehicle, but not electric vehicle, not lithium battery. Oh, no, it's hydrogen. It's all about power. And the guy he had a SPAC. He went on CNBC in like March 1st, 2020, before the whole like COVID crash, really. And so he was like, just by serendipity, was so lucky to it. And I have to say, like, I did an interview today where I talked about instinct and intuition. Like, I knew in my bones when I saw this guy on CNBC in March 2020 that something was up. I had a bad feeling about it. And of course, this SPAC went from $10 to like $70. And now it's at, it's less than $10. I think way less than $10. And the truck ended up, they did some demonstration where the truck was going, oh my God, it's going on water vapor. Hydrogen is so cool. The truck was rolling down a hill. It wasn't actually the engine moving it. Like, so there's tons of fraud and wasted money and stealing money, taking advantage of vulnerable people that happened within the stock market and not crypto. So I think that's important to say. And, there are people who are promoters of a lot of stocks and went on financial channels saying, Nick, this is a once in a lifetime opportunity. And somehow they still have a shred of dignity and it's quite incredible.
No, I'm glad you brought that up. I agree. I think it's a very important point. There was like a bunch of examples of that during the COVID era, if we can call it that. And there's probably more that haven't been unearthed yet. I know, like, you've had a cool guest, Mark Cahotis, right?
Yeah.
There's people like Mark out there who are like awesome at finding these frauds, and I love that he does what he does, and people like him do this work because it needs to be done. And it's always amazing to me that like these fraudsters are able to pull this crap off. It just shows you how powerful the human desire to make money is that we're susceptible to fraud because we so desperately want to make money and become rich or whatever we're dreaming of in our heads when it comes to this stuff.
Yes, and it's very easy to get wed to a narrative. Like if you buy a lot of treasury bonds, and generally treasury bonds make money as the economy slows down and enters recession, like suddenly, like you take, Nick, if you today, just your normal guy, I asked you, what do you think about the recession odds? You're like, well, look, the economy, it's getting a little weaker, but like, I don't know, I don't want to make a recession call. That would be irresponsible. Like, things can always get better. Like if suddenly you owned tons of treasury bonds, like tomorrow you'd be like, Jack, the recession is coming. It's here. It's now. Like, it's just, so people get very biased and, it's not even financial. People can just get wed to a narrative. They hear about like, like anytime the government prints money, it's inherently deflationary. So the huge money printing that occurred in March 2020 is going to be deflationary. Like, obviously that was wrong. And they're very smart people who have these beliefs. And it's like they're really smart and intellectually focused and like rigorous on everything else except their beliefs. It's like, it's kind of like if in a comedy club, it's like you could say a comic can say super offensive stuff about like topic A, topic B, topic C, and like someone's fine with it. But as soon as they hit topic D, like that's their thing, and it's like, what did you say?
Yeah.
Did you say that printing money is inflationary? Is it deflationary?
Right. Yeah. Yeah, and you see that dynamic play out in like the FinTwit battles that happen, which are kind of funny because these are like grown adults acting kind of foolishly on the internet, which is cool.
Yeah, it is, and I don't know if what do you make of FinTwit? See, I feel like on FinTwit there are professionals who are there kind of just to like track things and have a public profile, maybe if they share their name, but like they're not professional posters. And then there are professional posters who have like 1 million followers, and it's not like, oh my god, he has 1 million followers, he must be an expert. It's like it's in many cases it's the opposite. There are people who have like hundreds of thousands who really know what they're talking about. But like I would say it's shocking how many incredibly smart people on Twitter have like 200 followers. You know what I mean? And I follow them, and I'm like, wow, I can. And also, this is kind of a skill I picked up. Like maybe I'm overplaying my skill, but like I really can tell if someone knows what they're talking about, or if they're like a poser, and I can tell it pretty quickly. Like that's probably one of the few skills that I feel like I actually have.
Yeah, I think so too. I think that's why you get the guests that you get, because the serious people, the serious practitioners of the art of investing, they sense that you're looking for them, like, and then you find a way to connect with each other. Because there's a lot of the other thing out there, some of which have bigger followings and whatnot, as you pointed out. Yeah, I don't know. Like, I was actually going to ask you a different question about FinTwit. So maybe let me ask that before I give my opinion on FinTwit, because I think this is potentially an interesting question. So part of what you do with forward guidance, which is something that sort of all modern macro investors have been doing for quite some time now, which is sort of like this Fed watching, because it's become such a thing. Like everyone's paying attention to the Fed, and people are, maybe even the algorithms are placing their bets based on what the Fed does. But my question was kind of in reverse. Like, do you think people at the Fed are looking at FinTwit and using that information in any way, shape, or form?
So that's a great question. I first want to acknowledge that I'm biased towards the answer of yes, because it would flatter my ego. In the same way that, like, do you think that Jamie Dimon is looking at commercial real estate investors in LA who have properties in Atlanta? It's like you want to say yes because it makes you feel good, So I definitely want it to be yes. I don't know. I think maybe some of the staffers who are younger probably do. I mean, there's so many of them that odds are that some of them like definitely do. But no, I don't think I don't think Jay Powell or them are on Twitter. I think Jay Powell does have a Twitter account, but it's like the super protected kind where you can't even follow him if you want to, you know. And he apparently like has like liked one thing in 2017. I don't have that detail right, but if you look up Jerome Powell Twitter account, you'll find what I'm talking about. I don't I don't think so. Here's the thing, because they're old school and like, you know, they're 50-year-olds, 60, 70-year-olds, like they kind of put a emphasis on what was popular and relevant in the 2000s. I'm not saying that like TV is not relevant, but I just think it's become, you know, it used to be the only game in town, and now it's not, as you know. And so I think that, like, yes, I think they definitely have the TVs on, Bloomberg, CNBC on, and yeah, if a big time investor goes on and says, I think inflation is accelerating, and it's just getting started, like, yeah, they probably note that. But if some super smart person on Twitter who has 100 followers, who's anonymous, like lays it all out in in a box about how inflation is going to accelerate and wildly, and oil stuff like that. No, I don't. Maybe they should. Like and you got to filter through the crap on Twitter, but there is gold there, and I think so. I think probably not the staff, but yeah, I think, you know, I post threads sometimes, and like they get a fair number of likes, and there are threads some people post about like, this is going to happen, here's why, and it has 2,000 likes. Like, is Jay Powell looking at that? My answer, no.
Yeah. I think
probably
that's probably, yeah, I think that's probably true too. And I think the reason I was starting to think about that is because ultimately, like, take somebody like Jay Powell, right? And he's become more than a man, but he is just a man. And he's a human being like me and you, and he makes decisions actually like we do. And when you're a celebrity in power in that position, it's easy to forget that. And so I do think there's a human side to some of these public figures, you know, like the Yellens of the world or all the Fed governors. And I wonder how they're making decisions, and whether, like, you know, for example, like there was a period of time when the Fed was like team transitory. And it was obvious to like anybody, not just the smart gurus on Twitter. It was obvious to like anybody in business that inflation was not transitory. And yet you're very intelligent people who've been in power their entire adult life who basically just ignored that. And I wonder how that something like that happens. Like, did no one wrote them a memo about it, like in the staff? Like, it just, to me, it's mind blowing. What do you think?
Yes, I've got a few things on that. Number one, the Fed, like, totally wrong about team transitory, and they've admitted that. I do think that the economist, the profession of the economist, you know, the dismal science of economics, of making, and particularly statistical economics. I'm not talking about like John Maynard Keynes or stuff, or like the theoretical stuff, but specifically like, oh, it's called, you know, econometrics. Like, we have all these models, and our models are saying it's there. Like, there were models at Goldman Sachs, Wells Fargo, every single place that were also saying it was transitory. So like, you know, you if you turn on CNBC in you know, May of 2021, the Fed was saying it was transitory, but there'd be a strategist from Bank of America, wherever, that would be saying it was transitory too. So I feel like, you know, the strategists and the economics profession who don't work at the Fed, they're kind of escaping. Well, like when we pin all the blame on the Fed, they're kind of escaping the fault that they were wrong too. And I think you're absolutely right. So I'm like in the media, in the financial world. So you can say in the same world of the Fed, of not like, oh, I'm an employee and I have 10 employees and I'm noticing this. I'm noticing the price of sand. Like I'm like, you know, my business is I make sand, I buy rocks and I crush them, I sell sand, and I notice that the prices are going up. Like, you should be listening to those people, and the Fed, we're not listening to those people. You're right. But I also think that, you know, there can be a lot of anecdotes. Like, someone in 24, I bet there were a lot of sand producers in 2014 who said like, inflation's coming, you know what I mean? And they were wrong. So it's like, you can't listen to people. Like, there's always going to be a narrative, you know what I mean? People are always going to say, well, the real inflation rate is 20%, or actually deflation is the risk. Like, you do have to have a process and be somewhat objective. But yeah, I mean, they should have looked at the business surveys and just listened to earning company calls. And this is something that, I'm not in the sand business, and I don't have like a real, business that would be involved with inflation, but I was listening to company earnings calls. Like I remember in 2021, and Warren Buffett at the pretty high profile Berkshire Hathaway annual shareholder meeting, he's like, yeah, like companies are raising earning prices. Companies are raising prices on us, and we're raising them even more. Like we're passing them on. Like, and I was like, like I wonder if the Fed's paying attention to that, and maybe they were, but they just didn't factor it enough.
Yeah. I think it's possible. Another thought that I've had in my head, it's possible that the Fed has a different sort of decision matrix than we think they do. And maybe they did know, like there's game theory where like the Fed absolutely knew that inflation wasn't transitory, but they wanted to extend the admission of that for as long as possible for whatever reason, that they had a bigger, a chess-like plan that they wanted
political, perhaps.
Exactly, or politics. Yes.
I think there could be something to that.
Yeah, because again, they're human beings. They're like anybody else, and so you can't assume that they're not going to act like anyone else would act.
Yes, and I want to be careful of what I say, but like, if there's someone who joins the Fed who's an economist who was a senior economic person from Party A, from a previous president, and now another person from Party A is president, and that person joins the Fed, like, oh, surprise, surprise, that's the one person who wants to stop hiking rates. Like there's something to that.
I totally agree. Yep. Yeah. And people underestimate the extent to which that matters to a human being. Like their relationship with somebody in power and stuff like that. Like this is like hits you at a psychological level that is pretty deep, and it can cloud your judgment or make you like so biased in one direction that you will ignore information, or you won't seek out information that would make you change your mind, that kind of stuff.
Yeah, definitely. Yeah.
So what do you think? Do you think this inflationary pulse that we just went through is over, or we got more on the table?
I don't know, man. I'm really not qualified to answer that. I don't know. I feel like it's I may as well just flip a coin. I think we're entering a recession pretty soon. And I know people have been calling that for 12 months and it hasn't happened yet, but I don't know. I think especially with this banking crisis, and historically recessions cause inflation to go down. So I probably am on the camp that inflation comes down, but I don't think it will reaccelerate. I don't think core inflation will reaccelerate. I think the price of energy is going up, and you had OPEC cuts, so the price of oil is back over $80. But I don't think inflation is going to accelerate. But if core inflation stays at 4% annualized, like that's still a problem. And I just have a feeling that I think the Fed's gonna. If you ask me what's the Fed going to do, I think they hike 25 basis points at the May meeting, and then they're probably done. And that's what the market's pricing in. Like I feel like sometimes I have a view about what the Fed's going to do that's different than the market, and in that case, it's like, oh, actually, this is notable. But like, I kind of agree with the market, But I say 25 and done.
Yeah, I'm with you. I think it's probably close to done. But this energy thing is like a little wrinkle in the equation, because that was like a positive data point for the trend, because oil had already come down by a ton, and it was looking like it was trending lower, and then bam, it didn't go up as much as I thought it would go up. Like what is it up like 5-6% from the day that it got announced from the OPEC cut?
I know the low was maybe about $67, and now it's at $81. But the OPEC cut could have been announced when it was at $72. So yeah, around there.
It's like 5 or 10%. Yeah, I thought it would be a lot more. Yeah, and that's problematic for the number. And then the other big one is what happens in my world with shelter inflation.
Definitely, we can get into that. But just on the topic of narratives, Nick, there's been this narrative that there's a lot of smart people believe this, and there's a lot of evidence to support it, that from 2009 to 2014, you had a fracking bubble where private equity and all this IPO money would go to fund the production of fossil fuels, regardless of the cost. Like, oh, your break even is $80, no problem. Here's $1 billion. And you had a giant bust when the price of oil went, I think, a little below $30. A huge crash in 2014, I think, when OPEC like flooded the market. And the narrative is they've changed. They've learned from the mistake. All the people who are money losing CEOs who develop projects at $80 break evens, they've left. And it's like the company, they're focused on share repurchases and giving capital back to shareholders. And it's funny just observing the narrative. Like, first I see the experts and the sort of the cognoscenti in the energy space like say that in like late December 2020, and then I start seeing people on CBC saying it in 2021. And it's just funny to see how the narrative kind of sort of like spreads out. And then I see like, just random people saying it. And then it's like a common knowledge narrative. But knowledge is something that's true. And this may not necessarily be true. It's like no one's talking about how so many people are fracking and doing tons of oil exploration. And I'm not going to say the name, but like there's a Canadian oil name that it's a very small cap name. So it's like people are like, oh, I think it's this one. It's not. Like they're like tripling their production this year. So I think when people, it's like, oh, but Jack, don't you know that oil companies aren't making new production and that like the supply side is constrained? It's like, no, I don't know that. Like, look at Hess and look at what they're doing in Guyana. Like the ticker is HES. Like, tell me then that the fucking supply constrained. So it's like, look at the facts, and it's like, oh, why did the price of oil collapse? If the fundamentals are so strong, why did it collapse from $120 to $67? Like that, that doesn't seem like there's a lot of shareholder discipline or, capital discipline to me. Like there's a lot of, yeah. And also people will say like, oh, but it takes so long to put these projects online. And that's true from just like, if you want to turn like a field of grass into an oil well, it's going to take a few years, but they have spare capacity and stuff like that. And so that's on the oil front. That's just an example of just narratives that it's like, I don't like. There are people who still believe that, who are doing the work, and they'd be like, oh, Jack, that's a good point. Like, yes, I was a little surprised by this, but I still believe that going forward. But like, if you just blindly hold to a narrative and ignore the facts, I think that's just a mistake.
Yeah, that's a great point, and that's a super important sector. Like I've been thinking a lot about the American sort of shale production or fracking production capacity, because it has this like interesting potential to be a geopolitical weapon, actually, if America was smart about it. And I do think some of these companies have recognized that. That's probably why you're seeing some counter narrative activity from the investment standpoint, because American oil is like very actually important on the global scene now. Whatever it is, what is it, like 12 or 13 million barrels a day or something like that is the capacity. And so like if you take an OPEC cut of 1 million, like, okay, fine, whatever. We got 12 or 30. We could, if we actually had the ability to ramp it up, we could outdo OPEC whenever we wanted to, essentially, which could be really interesting.
Right. Yeah. So those numbers, you're in the range of correct. I think the peak was like 14 million barrels a day, maybe 50 million. I don't know, but like you're within an order of magnitude of being correct. And I think that this is another thing. Like when OPEC cuts, they cut their like imaginary target, but if they're not producing up to a certain target, that doesn't really matter. So I think there are a lot of things that like can make the headlines and it seems like it's a big deal, but once you dig into it, it's complex. And you know this from the real estate industry. Like it's like, oh, it has a 6% cap rate. It's like, well, it's just a little more complicated than that.
Yeah.
But and we talked about that in our interview, which people should check out. Yeah, it's also on the Russian side. Like the price of oil just exploded higher because of supply constraints. There's not enough oil, but it's very hard to distinguish between true demand for oil and there's not being supply there versus people bidding up the price of oil because they're speculating, and so oil was trading like a geopolitical premium on the basis that these Russian barrels wouldn't get to the market. But like, I got news for people, and it shouldn't be news by now, but like the Russian oil like made a market. You know, you read about Latvian blend, about how it's like 51% Latvian oil, like 49% Russian oil. India is, you know, their purchase of Russian oil went up, you know, 10 times, so something to that effect, maybe a little more. China buying tons of Russian oil. So yeah, and again, I'm not an oil expert, but like if you're, you know, I'm not confident in my knowledge of, I'm just confident in how much complexity is there and how much like money you leave on the table intellectually and financially if you're just like not aware of just how complex it is, you know?
Yeah. Something you said to jog my mind about another question. It's kind of a complex question, but you went there, so I want to ask it, which is, so in your last answer, you basically pointed out that like the surge in oil price was related largely to speculative activity on Wall Street or around the world, not just Wall Street, around the world. And so one of the questions that I've had in my mind for some time that I want to ask you is, you know, you're in this macro world every day. You're watching these capital flows. You're watching these assets move up and down. And the common accepted narrative out there in like academia, for example, is like that all of this activity, even though it is speculative, like ultimately leads to, you know, a more effective or efficient capital allocation. And I'm curious if you believe that. Like, is all this actually a force for good, like magically a force for good and capital gets allocated? Or is it just like gambling and then more gambling and more gambling and capital just kind of goes where it goes based upon that? Like, what's your gut tell you?
Yeah. So I'd say like, I'm not a like free market ideologue. Like I love markets and I love finance, but like what I've said is like, if I was born in like the Soviet Union, like I'd be writing a report about potato production. You know what I mean? Like I'm just focused on the thing. And I think like it's pretty undeniable that like free market capitalism has had a lot of benefits to it. Your point, I don't know if all this speculation, like I'm just here for the speculation. You know, I'm just here to cover the speculation because like I'm interested in it, and it does relate to the real world, and I'm interested in that sort of interplay. Whether you say that speculation is inherently good, like, you know, does an airplane stock need to go from $100 to $2 to $200 for there to be price discovery? Like, I don't know. I don't know. Maybe the answer is no. Maybe the answer is it is a unhappy byproduct of like the free market, that the free market itself is good, but it just has a bad byproduct of all this speculation, and the speculation itself is not good. I really don't know, Nick, and I don't think a ton about this. What do you think?
It's a question that I've never been able to really answer because I feel like I can't imagine a world without markets. I feel like markets are there to as a reflection of like something inherent in human nature. You know, like in societies where they've attempted to get rid of markets, like bad things start happening, you know, so I feel like markets are are part of what it means to be human. But I do worry actually about the extent to which they enable our human tendency or human nature to engage in speculation. And especially when they start impacting geopolitics, right? Like it presents the possibility for big accidents. Like you could argue, for example, like historically, like the Great Depression, right, was like a consequence of like a massive speculative mania type thing that didn't get handled appropriately by the policy people in power at the time, and bam, all of a sudden you get to World War II as a result of it. So like it's not like it's benign, that's for sure, and that's what's troubling about it, I think. But I don't have an answer.
Yes. So I'll start with the Great Depression. I think like what caused it in Germany, I think was like reparations and not even trade policy. People talk like the Smoot-Hawley tariff. Like I read in a book. I'm not going to pretend I know it just because I read it in a book, but like that it you know that itself was not like as relevant as people say, like the tariff. But just the fact that Germany owed all of this money from World War One, and the Allies were what used to be the Allies in World War One. So England, France, and America were like pretending like that you could pay it, and it couldn't. And it was a debt that was denominated in sterling, French francs or dollars, whatever, just not Reichsmarks, not German currency, and that's a problem. Like if the U.S. we have tons of debt, but like it's denominated in dollars, like it may be a problem, but it's manageable. Whereas the German debt was not manageable, and yeah, and I also think the banking system just sort of melted down in the United States, and we didn't have FDIC insurance. That's one thing. That's how the FDIC started. So I think like you can have a popping of a speculative bubble that has bad consequences, but doesn't cause a global depression. That's just my own opinion. I don't know if it's right. Oh, I know what I was going to say before, that I think a free market doesn't mean that everything is quoted every single second, and you have options on stuff that are quoted every single second. Like the real estate industry, like you buy a house 2015, you sell it in 2024. Like for 9 years, it's just like an illiquid asset, and that's fine. Like, and I've heard Charlie Munger say that he thinks the world would be in a better place if there was much less liquidity for. I'm not talking about central bank liquidity, like just the money printer, go burr. I'm just talking about like the ability to enter and exit a position without any cost. Like, oh, I can buy an Apple share for $140, or I can sell it for $140.01. Like it's pretty, especially with no brokerage fees transactions. Like it's pretty effortless to transact. But maybe transacting, like you shouldn't transact. Maybe you shouldn't transact unless you need to transact. Like and Warren Buffett makes this analogy all the time. Like if you buy a house on Monday, and then on Tuesday you get quoted for a price that's lower, 5% lower. Do you want to sell your house because it's quite lower? But that's literally what people do in the stock market. It's like, oh, I'm getting out of the position because the market's telling me I'm wrong. Which actually, if you are a short-term trader, which I don't recommend at all, like that actually can be a good risk management. Not good, but it can be an effective risk management tool. But it is quite silly if you compare it to real estate. Yeah.
Yeah, it's a good point. I think Munger's right about that. Like, as a real estate investor, the transaction costs are so high that like you really think seriously about, or you should. Like the times where I've lost money is when I didn't like think hard enough about the purchase I was about to make, because it's like at least 5% on either side. Maybe, if it's a complicated transaction and you have loans and stuff, like paying lawyers, it gets close to 10%. And so, yeah, you need a lot of things to go right to overcome those transaction costs. And yeah, we're going, taking it full circle back to the crypto conversation. Like there's a big movement, which I'm excited about personally, about this idea of like how many real world assets can we tokenize and have freely tradable. But maybe that's not all a good thing, because the liquidity thing is going to drive the same kind of stock market behavior into other segments, because you can just trade your tokens once you get it.
Yeah, and like let's say people want to tokenize Kentucky bourbon, which is a thing. Like I'm not saying that's going to make the world a horrible place, and I'm not saying it's going to make the world a much better place, but like you don't need to invest you don't need to invest in everything, like your shirt, I'm sure you like that shirt, but like no one needs to like, oh, I need to increase my allocation to like the black shirts that are owned by Los Angeles real estate developers. Like I'm underinvested, I'm underallocated, I need someone to buy me these shirts. Like you don't, and this thing's about like, oh, I'm investing in wine, I'm investing in all these things. Like, art, I think art and wine actually have a like effective track record. Of like people buy them for X and they can sell them for 2X. But that doesn't mean that like if someone who's like, working a job, saving money for 401k, it doesn't mean that like sell your stocks and buy some like Picasso. You're like, here's my investment portfolio. Like it's my wine cellar, like, I don't know.
Yeah. What do you think? I read just the other day, like there's a company that has gotten a couple like up and coming professional golfers to sell shares in their future earnings. I think it's called like Commonwealth Markets. They were originally selling like shares of racehorses, and then they got a couple of professional golfers. And I know that that's not the only company. There's other companies out there who are taking. I actually think it's a Warren Buffett idea, which is like at one point he gave advice is like, oh, find really smart young people with integrity and invest in their careers. Like that's the best investment you can make. And so there are companies out there.
I think so he may have said that like as a serious idea. But
Yeah.
I saw a lecture where he gave that to students, and he was saying like the best thing I could do is like I'll take all the smartest people in this room and like invest in their careers. But it was like a hypothetical, as if like, oh, wouldn't this be a great idea? Like he wasn't saying like, let's do it, you know?
Yeah. Okay. Yeah. He wasn't saying like, let's create this share structure and like, let's do it. Yeah.
Yeah. But
Yeah.
no, I mean, that's an innovative idea. And like a lot of things in finance now that are integral, like were ridiculous ideas, you know, when they were first proposed. So I generally welcome financial innovation. Yeah, I mean, I just think if you have like a huge, something that becomes a huge unregulated asset class, like, you know, regulation is generally good. Yeah, I feel like.
Yeah, totally. Well, I want to switch gears. I got a couple more questions. I know we're kind of running towards the end of this, but I want to switch gears and talk about a few other things. Thank you for offering your market opinions on everything I asked you. Was basically like there is no answer because we live in an uncertain world, but you at least attempted to answer it. So thank you.
Yeah, well, I feel like, you know, this interview. By the way, this is you're doing a good job interviewing me. I'm really enjoying this. Like, I feel like people may watch my interview and forward guidance, and because I'm not sharing my own opinions, people are like, "Oh wow, like that's, you know, okay, that's a good question." And I'm, you know, interviewing this like really really smart people, so it's kind of like I'm not on their level, but I'm like being in the same room as them. It just like makes me look good. But I feel like once people actually ask me what I think, people are like, "Oh wait, what? This guy doesn't know what he's talking about."
Yeah, that's funny. Yeah, I mean, one of my opinions, just observing you as you've launched this podcast, is that you've developed like a really good way of interviewing, and you get to an understanding, or you get to a place where you can ask questions to people that are like authentic, and it's clear that you've done your research and all the things that you would want in an interviewer. But I'm curious, like, did you just come up with that? Did you have a mentor? Like, how did you get good at this?
That's a good question. Yeah. At the previous company I worked at, Real Vision, I had people I was working for, who were very good interviewers, and I saw like, oh, they were. And this, by the way, it's thinking about people who are much older than me, or mentors, but also people who are, you know, only a handful of years older than me, who I sort of learned alongside. And I think that's actually a good process of like, if you can work with someone who is only a year or 2 or 3 years older than you, especially when you're a young person, it's like you they're on your level, but also you're getting to benefit from their expertise. And you know, I think it's also helpful having like edited interviews and seen an interview where it's like, oh, this what this person did is a really good question. Like, oh, this thing, oh, actually, like, you know, maybe like not, you know. So it's like you're learning from, you're just seeing how the sausage is made, and you're making the sausage. And I think it's really helpful. So yeah, like, I don't know, like, I think if someone wanted to be like a TV host, I think being a producer before it is a good role, because you can sort of learn from learn from someone who's doing it. And it's like your you know, if you want to be like a head chef, like, it really helps to have been that, you know, if you want to be a head chef, like, and you haven't been like a sous chef or like a line cook before, like, you really don't have the experience, you know. You should, you know what I mean? And yeah, I don't know. I also think like love of the subject matter and interest in the subject matter, at least, is very helpful. Like, I feel like if you're someone who's like, oh, I'm a host, like, my specialty is like in hosting and asking questions, like, that definitely is a skill. But I feel like you have to love the subject matter. You know, like, if I'm watching a cooking show, it's, let's say someone, you know, I don't watch a show where people interview great chefs, but like, I would want the like interviewer to like love cooking themselves. If they were just like, oh, I used to interview people about bikes, yeah, and now I'm interviewing people about chef, and it's just like I'm a host, like, I don't know. That's just it's fine for like generalist like business news, but I feel like I always like the interviews that are, I sort of get the host's like own interests, you know, and passion.
Yeah, that makes total sense. Yeah, because it's the only way you're going to like do the work and researched so that you're prepared to ask the question that's going to get the best answer. Is like if you're super passionate about this field. Have you always been like into finance and is this what you envisioned your life to be, or like what were you thinking about when you were like in college?
So I studied economics, and I think when people hear economics, it's like, oh well, like so okay, he studied it, but like economics is very dry, and particularly what is taught to undergraduates, it's very abstract. It's very like economics comes from the Greek's words, econ, which means like house, and noimos, which means management, and it's about the gains from trade. Like, oh, if you make fish and you're really good at fish, and I'm really good at making shoes, we're going to trade together, and that's benefits from trades. It's like that's fine, but like it's children level analysis. Like I feel like I'll say this: like I learned so much more. It's ridiculous. Like like after college, like then maybe it gave me a foundation. That's fair, But it's like, and I also was reading a lot of books about finance in college that were very different from economics. And I feel like in economics, it makes assumptions like everyone is efficient and rational. Which, like, if you read books about finance and financial history, you realize immediately that it's not true. Or just look at the market right now. So did I know I wanted to do it? No, I kind of this is a little embarrassing, but I went through a lot of different things. I didn't realize what I wanted to do until my senior spring, and by then I got really lucky in that I got my first job at Real Vision. Like I think really prepared me really well, and it gave me a lot of skills. And I think it, if I got a job at like a bigger organization, I don't think I might have been able to like access or gain the certain like knowledge that I was able to get. Take responsibility, because like I would just be one among like just like 1,000 producers,
Yeah, totally. And so you made the realization. I mean, that's not too late in life. I mean, I'm 43 and I'm still like trying new things like this, writing and podcasting. So being in college but you made the discovery like, hey, I'm into financial journalism and I want to give it a shot. That was the essential.
Yeah, and I kind of there was a time where I was writing articles for an institution called Deal Breaker, and I just kind of like breaking news and stuff like that, and I liked it. I really, I obviously consume a lot of written journalism about finance, but I think it's important for people to specialize. Like I was okay at it, and I could, but it wasn't really my calling, and I realized once I was doing this that number one, like I liked it more, and I thought I was like a little more effective at it than written. But also, it's just I think it's just important to go to a field where there's not a lot of competition. Like if you um, if you want to be the best like a basketball player or baseball player in the world, it's like good luck. You're competing against everyone. But if you want to like have a financial podcast, like it's you're competing against a small number of people. And a lot of those people have really good shows, but it's not like you're competing against everyone in the world. And I think that's important.
Yeah, that makes sense. When you think about your work at Forward Guidance, like, do you have like a mission? Like, are you motivated that way? Like, what do you think about that?
God, I don't think I can give you something other than something like really like basic, but I just want to share like insights from experts on finance about like how the financial system really works. It's just like there's like there's like econ there's below there's like econ like the econ like gains from trade, fish and shoes, and then there's like a generalist financial understanding, and then there's like, oh, okay, like I saw the channels and I saw this expert who said that like rising rates were good for banks, but then it's like dissecting it and actually like getting into it. It's like, well, are they? Like if the banks don't really make a lot of loans and they make them at really low interest rates, and they gave specialty favor mortgages at like 2% to like their favorite venture capital clients, and they bought over $100 billion of agency mortgage-backed securities with like a coupon of 2.5, like maybe rising interest rates are not good for banks. And like in the case of Silicon Valley Bank, it was not. So like I don't know. I just like getting into the weeds and just creating the best content, ever. Not ever, ever, but creating the best content possible. That's what I meant to say. And just like helping people understand, but it's not like, oh, I have this knowledge and I'm going to help you understand. It's like I'm learning from the guest and you're with me. Listeners are with me, like along for the ride. And I mean, I would like it if like everyone who or if so many people who listen to my show were like young people who were 19 who were getting into the field. And so like the people who need the knowledge most are the ones who are getting it. Like just from my audience demographics, like I know like there are a good percentage of my audience are like your age or older, 50, 60, and I think that's great. I love my audience, but it's like they maybe I don't know, maybe they don't need it much. Maybe they need it even more because they're like facing retirement and stuff like that. Maybe that's true, but like that's also a thing. Like if you're going to do, if you're going to like write a 500-page book about how to make bicycles, like you shouldn't expect that the core audience will be non-specialists. Like you should accept like, oh yeah, like most people who are going to read this book are like mechanics or people who want to become a mechanic, like don't be like, oh my God, like be lucky with the audience that you have and grateful for the audience that you have. And don't be like, God damn, why aren't these like 15-year-olds interested in, hearing about like credit risk transfers,
Yeah. Well, I think that's a good answer. And, as an outsider, like I feel like what you're doing is actually really, really impactful and really valuable. Like the financial world that we live in is so complicated, and the financial literacy out there, like broad-based financial literacy metrics are so bad that like there really is a humongous need for people, just in organizing their financial lives, but also for like their lives as citizens, because you can't really be like an effective citizen of a democracy if you're like don't know what's happening in this complicated financial world. So I view what you're doing as like really a really important function of demystifying this stuff in a way that's like not like attempting to sell somebody some product or something, which is how it typically comes at people. And I think that's like a super important like public good essentially. And
definitely.
So
by the way, that's why I subscribe to the Nick Caleris course of real estate.
Exactly. Yeah.
And we're doing a special discount, the premier package of the Nick Caleris real estate.
Like if you want to be a millionaire, by the way, I have a 2-day program. It starts on Friday and it's $40,000, and I'll send you the link for that.
Yeah, and actually, space is limited, but like we made a special just for you. And that's one thing you said to help people put their like financial lives in order, financial literacy. And yes, I think it's if that's a byproduct of my show, I think that's great. But there are shows that are like, this is how you put together a budget. This is how you invest. This is how a 401k system, like a how to. And that's just not what my show is. Like my show's ambition is to like show how the financial system works. And that's another thing. Like I think if people want to maximize their financial returns, but also like just savings, there are all sorts of things that habits that they can do that I don't discuss, like such as like like you're never going to hear me say like like talk about how don't go to Starbucks, make your own coffee, save money. Like that's true, but that's just not what my show's about, and that's one thing like I think people should study, not they should, but like I study the like the plumbing of the financial system because it's its own reward. Like yes, people who understand this, a lot of the people who understand this, like they may have good investment returns, they may have bad investment returns, but like the reason to study like like Central Banking 101, Joseph Wang's book, like it's because the knowledge itself is its own reward, like, and that's when I think like if you study like the trade policy and China has been divesting of its reserves of treasuries, like probably what's going to like make you money both in terms of saving and like investing is like making sure all your money goes in the 401k, making sure you're matching your age to, I'm 30 years old, so I should be 80% in stocks, 20% in bonds, whatever. If you're younger, more percent stocks. If you're 60, more percent bonds, whatever. Like that, and also not going to a cup of coffee. Like so, like I don't want to say like the way that you can make money of investing is recording my show. Like my show, like, many of the fantastic books behind me, like I'll just, one sec, I'll just show this, like A History of Interest Rates. Like, and I interviewed the author. Like this to say like the reason you should read this book is because it will improve your investment returns. Like I would view that as like an insult to the intellectual project that this book is. Like it's about tracking like line by line, block by block, like what were merchants charging on interest rates in 1790? What were they doing in 1800? And like, this is not like, should I buy TLT or IEF, or like what treasure, how long on the curve should I go? Like it's bigger than that. You know what I mean? It's bigger than that.
I get where you're going. And like, I think people should like get their baseline financial literacy and spend serious time on it. And what I see shows like Forward Guidance, like Forward Guidance is offering a different curriculum in a sense. And it's like, if you want to be a leader in a country like America, in my view, what the stuff that you're getting into, this plumbing and the weeds, like this is like required knowledge. And part of the reason I think our political system is so messed up is like, outside of the circles that exist on FinTwit and inside of Wall Street, like not that many people actually understand what's going on. And so I really view your show as like a window for people to at least get a sense of what's going on. And that will help inform how you react to things outside of your financial life, like what's happening in politics and geopolitics. And it's all related, and to assume that it's not is like the big mistake of our generation, essentially.
Yes. I think one example is the assumption that government finances should be reflective of a business. It's like, oh, Nick, if you run a profitable company, your revenue exceeds your cost. It's like, we should run the government like this. And it's like, yeah, maybe, but like not every government can run a surplus, because if every government ran a surplus, who would run a deficit? There's no balance, It's like if and that's another thing. If everyone beats the market by 10%, no one beats the market by 10%, and I guess it's the fancy word for, and this is the thing where economics is actually pretty good, is like, I think it's called the fallacy of composition. But it's like, yeah, everyone wants to beat the market, but if everyone beats the market, no one can beat the market. And then, yeah, it's like we have all this debt, like that sounds bad, and maybe debt inherently is a sin. Maybe we should curtail it, but maybe that's for other reasons, because we don't want to give like all these tax breaks or like government giveaways to like military industrial complex or whatever. Like that should be on its own merits. It shouldn't just be like $100 billion of debt. It's too much. Why? Because it sounds big, And so I think there is something to the MMT framework. I think we talked about it in our discussion, maybe briefly, that like government deficits are only a problem inherently if they cause inflation, And if a government deficit is $1 million, aka pretty small, but there's lots of inflation, that's a problem. But if it's $100 trillion and there's no inflation, that's not a problem, And I'm inherently making it ridiculous to just prove a point. So that's just an example of like the type of thinking, like macroeconomic thinking, that's like different than like, oh well, I ran a business, so I know how to be president. Not that
Exactly.
not that people who run businesses don't know how to be president, but just like a government purse is different than a business's accounting.
I agree with that, and I think part of the issue is out there is that this stuff is like relatively complicated. That's why like your interviews take an hour long to like dissect like one piece of it, and the more people who understand it, the better off we're all going to be. Because like presumably people who learn this stuff will get into leadership positions, and it'll enable them to make better decisions. Like what I think they did, the public policy leaders did with the SVB, right? I think they actually made the right call there, and they did so in a relatively short amount of time. And I'm assuming that they studied up on some of the stuff that you've been focused on with Forward Guidance.
Yes, but I think if there are sort of like technocrats who have this knowledge and they make decisions, that if they make the great decision, that's great. But I also think there's something like, if democratically elected people who are elected by the people, if they make the wrong decision, I still think that's fine. Like I might rather have democratically elected people who make the wrong decision than like technocratic experts who make the wrong decision. Like maybe I don't know.
No, that makes sense. Well, I appreciate what you do. I want to end this with two fun questions. So the first one is, and we'll have to probably limit it, because if I ask you to just give me recommendations, you probably have like 50 books and 50 people on FinTwit. But give me a few. Like if somebody wanted to like level up their understanding of the intricacies of the macroeconomic environment and what's happening with finance around the world, like what are some good books and resources online and shows like Forward Guidance to listen to and follow?
Okay, so number one, I gotta say Forward Guidance on Twitter at Forward Guidance. Me on Twitter, I'm at Jack Farley 96. It's funny you asked like who should we follow, and I'm like me. Books. Let's see. Let me say okay. So I think a book that's really good and also really accessible is Lords of Finance. That's about the four central bankers from the 1920s through the late 1930s. I'd also recommend Central Banking 101 by Joseph Wang, who's a frequent co-host and guest on my show for Guidance. And he on Twitter is at FedGuy12. There actually are a handful of people who I follow on Twitter who I think are phenomenal, who I don't have off the top of my head. Let me see. One sec.
Yeah, we can put them too. Like if you want it, we can put them in the
yeah. So I think Michael Pettis is phenomenal on Twitter. I think Nick Timros is obviously great on Twitter. Lou Crandall at FedWatcher, he's great. Doesn't post that much, but I recently interviewed him. Let's see. There's someone who, I don't know who these people are, but they're just great. At Citrini, CITRINI7. And then there's someone named Sir, let's see, at Sir of Finance. Like these people are bond traders who like post charts that I don't know what they are. I know there's some sort of interest rate spread, but like this is something like, there are, it's a specialty thing, and there are like people who invest long only fund managers who like they're like, what the hell is this? So like it's like kind of in the weeds bond stuff, and I don't understand it, but those are just a handful. Let me see on books. Let's see. Okay, Capital Wars by Michael Howell. Good, pretty in the weeds. Anything by Roger Lowenstein, he's phenomenal. He wrote When Genius Fails about long-term capital management. He wrote a book about the Fed called America's Bank, very good. Nick Timros' book $1 Trillion Triage, good, and it's recent too. Market Tremors, that's good. It's very very in the weeds. I'm reading some books by Perry Merling, who has taught many very smart market people such as Zoltan Pozar, and I'm reading. I read his old book, the New Lombard Street, and I'm reading now his new book, which I hope to interview him about on Forward Guidance, called Money and Empire, about Charlie Kindleberger and the dollar system. Keeping at It by Paul Volcker. I got another book by Roger Lowenstein. Okay. When Money Dies by Adam Ferguson. Manias, Panics, and Crashes. This book, this is the one to read. Let's see. Sorry. Okay, another book by Charles Kindleberger, The World in Depression, 1929 to 1939. That is phenomenal. Sorry, one sec. I'm just kind of Globalizing Capital by Barry Eichengreen, academic but very, very good. Anything by Michael Lewis. I mean, The Big Short obviously is a phenomenal book. I've interviewed some of the folks who were in that book. Okay. This is like a deep cut, but this is The Money Noose. I interviewed this author, Scott Skirm. He's a repo expert. It's about John Corzine, the collapse of MF Global, which is a parallel thing to FTX. Unfortunately, a lot of people from MF Global got their money back, but unfortunately, I don't know if FTX. We'll see. I mean, I hope, but I don't know. This book is very in the weeds. Second Bank of the United States by Dr. Jane Nodell. I talked about history of interest rates. I've got more in my other room. I listen to some books and audiobooks. Because I want to make sure people, I give people the best, like.
Yeah.
Okay. Adam Tooze. Okay. Adam Tooze is really good. The book that he's like most well known for is Crashed, which is excellent. My favorite book would actually be The Wages of Destruction, which is about like the German war economy in the 1930s, and it's really like a very eye-opening book. Anything by Bethany McLean. Oh my god, like all the smartest guys in the room about that's like one of my favorite books. And Reminiscences of a Stock Operator. Got to read that. The Prize, Big Short, Devil Take the Hindmost. Okay, Devil Take the Hindmost. Debt by David Graeber. That's good. Quite theoretical. Deficit Myth, MMT book. Very good. All the Devils Are Here. Okay, so I've said a lot of books. Most Important Thing by Howard Marks. World for Sale by Javier Blas and Jack Farley, which name kind of sounds similar to me. Okay. Asian Financial Crisis by Russell Napier. Very good. Okay. So if I could only choose three, I'll only choose five. I would say Lords of Finance, Devil Take the Hindmost, Reminiscence of a Stock Operator, Too Big to Fail by Andrew Ross Sorkin is very, very good. There's I don't know. It's tough. It's tough.
Those are some phenomenal recommendations. I mean, that was like a year's worth of reading, and I haven't read all of those. So I actually got some great book ideas. I've read maybe like 30-40% of that. So I'm definitely going to check it out.
Honestly, Nick, that's really impressive because like books are so specialized. Like this is like my book universe, and there are so many financial books that I know are like, just as good as that, and definitely like just as, rich and engaging as that. That like there's so like honestly, like if there was a similar list, I don't think that I would have read 30% of them. So you were very well read, which I like how you're a very well read guy, but unlike me, you don't feel the need to flex.
Yeah, I do have behind every giant bookcase that it's appeared on some shows before, but yeah, I'm hiding it. Yeah.
Okay, nice.
Yeah.
Well, I interviewed a guy recently. His name is John Maxwell. His book collection really put mine to shame. Like they were stacked on the floor, and they were all about not only all about finance, they were all about banking.
That's cool. Yeah, if I could, like, that's what I would do all day is read books, which is part of the reason why I'm sort of like, I obviously still love my company and my business, but I'm spending more and more time on this creative stuff. And in order to create, you have to like consume a lot of information and learn and get new ideas and stuff. I really enjoy that. Okay, last question. And this is just like a fun thought experiment that I want to end on, which is, imagine for a second that you're completely in charge of the Fed. There's not even a vote. Like, you are the one person in charge. What are you going to do at the next meeting? What are you going to say, and what are you going to do?
I don't know. I might go Joker style on them. I might say, I don't know. I mean, interest rates are not high historically, but they are high for the bank for what the banks own on their balance sheet and the yields that they pay. Interest rates are quite high, which makes sense given where interest rates were. I might say, I might do a 25 basis point cut and say the next meeting I'm doing 25 basis point cut, and we may stay it for a while, but next year in 2024, be prepared for up to 300 more basis points of hikes, and I'm going to do it based on how I feel, so nice. Based on my mood. So don't piss me off.
Nice. I have a feeling that you might have that view, because I kind of have a similar mindset, which is like, I actually think they went too far in like the stress that they've been induced in financial conditions is like actually a real problem. Like we talked about actually on your show in my space. And even though it sounds crazy to cut right now, I kind of think it's a good idea. It's or hold or cut.
Yeah. And people should know, I mean, it's your show, but like on the business networks, there are some real estate people who come on being like, the Fed should cut. And it's like, they want to cut because they want cheaper money. But like, I can tell you, this is your real opinion, and like, you're not, your real estate investor is not like impacting that. And yeah, I think you could be right. I mean, I don't know. I think it is possible the banking crisis is over. Like, it also is possible that it's not over and going to get like really, really bad. The bank credits on the bank balance sheet, and the Fed has something called the H8, which they release, and there were some declines. So bank balance sheets are shrinking, which makes sense during quantitative tightening. But a lot of people are saying, "Oh my God, the banks have stopped lending," and it is worrying. And I'm hearing anecdotes from folks such as yourself that the banks have stopped lending. But like I think it's important for people to realize that like counted in bank credit on the H8 are actually like treasuries and mortgage-backed securities, which were like bonds. So it's a little confusing. But yeah, I don't know. I mean, I think it's a good thing that Jay Powell is in charge of the Fed and not me, because I don't know. I think that they made a mistake that we talked about earlier of not hiking too soon. Of not hiking soon enough. If they had started, in the summer or even in, November of 2021, they could have gone slower and then gone 50-50-50-50-50 instead of 75-75-75. And maybe that would have given the banks some more time to realize that he was serious about it, about hiking rates. Maybe in the parallel universe where they started hiking in the summer of 2021, Silicon Valley Bank was still foolish with their interest rate risk management and still had failed. So I don't know.
Yeah, it's hard. It's hard to say, but I do think that was probably what they should have done. Start sooner. They should have started sooner for sure. And then it would have been so dramatic, because I think that's what's really gotten people in trouble.
And I will say is like, I think critiquing the Fed is fine and like justified the Fed itself is like very aware and publicly has owned the mistake of not hiking soon enough. But I'll say like there are people who like always hate the Fed, and like when interest rates were at zero, they were, mad that the Fed wasn't printing more money, and and when it was at 25 basis points, they were like the Fed is making a giant mistake. Like there were people who a year ago were saying the Fed needs to hike more. Come on, Jay Powell, do it, stop, blah 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 blah. And now that he's actually done it, they said the Fed hiked too much. Literally the same people. So it's like the fact that it's the same people isn't necessarily like people should change their minds, obviously, and that it may be appropriate that the Fed should have hiked a lot more in March, and it should have stopped later. But like, don't have someone be your identity of like, oh, I love the Fed or I hate the Fed. Like, it's just not going to be very good for like your framework, I feel like.
I think that's a great point. And a good way to end this. Well, listen, man, thank you so much for all your time and your thoughts. Appreciate you, and look forward to doing this again sometime.
Definitely.
Thank you for listening to the Nick Halera Show. We hope you enjoyed the episode and would appreciate your help with spreading the word by sharing with your network on social. And until next time, remember, it's not about pursuing success to unlock fulfillment. It's about learning how to find fulfillment in the midst of success.